According to the findings of several studies, about one-third of households are already concerned about their ability to make their mortgage payments. The Bank of England, BoE, has issued a warning that millions of households may experience a big increase in the amount of money they are required to return by the end of the year 2026. According to a report by the BBC, the Bank of England has stated that mortgage holders may struggle with repayments as a result of continuous increases in the base interest rate. These increases have been made in an effort to reduce the extreme levels of inflation. During the month of December 2021, the base rate was only 0.1%, which made it more economical to borrow money. In August of 2023, the base rate is set at 5.25%. Because of this, it is possible that consumers who have debt, including mortgages, have noticed an increase in their outgoings. As a result of the expiration of fixed-rate mortgage packages, monthly mortgage payments for millions of people would increase, according to the Financial Stability Report published by the Bank of England. By the end of the year 2026, the bank anticipates that 2 million families will have increased monthly payments of between £200 and £499. There is a possibility that the monthly payments of an additional 1 million mortgage holders may increase by at least £500. Check your mortgage to understand how you could be affected by soaring interest rates. You might be able to better plan for an increase in your repayments if you have a better understanding of your present mortgage. If you have a mortgage with a variable or tracker rate, it is quite probable that your monthly payments have already made an increase over the course of the past 18 months. Much if inflation is beginning to decline, it is still rather high, and the Bank of England has the ability to raise the base rate much more. Because of this, it is important to consider how your finances might be affected if interest rates continue to rise. According to the research from the Bank of England, people that have mortgages that are on a fixed-rate arrangement are likely to experience the most significant financial shock. It is possible that you have been protected from interest rate increases up to this point if you set your rate of interest before the end of 2021. When your present agreement comes to an end, it implies that your repayments might skyrocket to a far greater extent than you anticipate. As in the month of August 2023, Moneyfacts reports that even the most competitive remortgage rates are more than 4%. It may be helpful to discover methods to update your budget in preparation if you take some time to evaluate how the current interest rates would affect your repayments in comparison to the repayments you would make under your fixed-rate arrangement. Check to see when your current mortgage offer expires, regardless of whether you have a fixed or variable rate mortgage. When it expires, your lender will often switch you over to their normal variable rate, which is typically considered to be more expensive than other packages that are equivalent. If you shop about, you might be able to find a mortgage that would reduce the amount that you have to pay back. 3 useful options if you're struggling to meet higher mortgage repayments. If you're struggling to pay higher mortgage repayments, don't bury your head in the sand. There may be steps you can take to balance your outgoings while remaining in your home. Here are 3 options you could consider. Number 1. Take a repayment holiday. A repayment holiday is not a solution that will benefit you in the long run, but it may provide you with some relief if you are experiencing difficulties in the near term. You can negotiate an agreement with your lender to take a break from making payments on your mortgage. It would make it possible for you to temporarily lower or cease making payments on a monthly basis. The ability to overcome short-term financial issues might be a helpful use of this. Consider the following scenario: you have been forced to take time off from work due to a major sickness. If you make a request for a repayment holiday, your lender will evaluate your situation, which will include a review of your prior payment history. For you to be eligible for a repayment holiday, many lenders may demand that you have already made an overpayment on your mortgage. Get in touch with your lender to explore your alternatives and see whether a mortgage holiday may be of assistance to you. Number 2. Extend your mortgage term. The duration of your mortgage payment is known as your mortgage term. Extending it to make your repayments more evenly distributed over a longer period of time is one strategy to lower your regular outgoings. Assume that you have £200,000 left on a 20-year repayment mortgage with a 5% interest rate. The £1,320 monthly payments would be made. The amount you would have to repay if you extended the mortgage term to 30 years would be £1,074. There are disadvantages to prolonging your mortgage term, though. You will pay more interest overall since you will be repaying the amount over a longer period of time. You should also take your situation into account while extending your mortgage. For example, a lot of lenders will prefer that your mortgage term expire before your retirement. Number 3. Switch to an interest-only mortgage. Most individuals get a mortgage with repayment. This means you pay down a portion of the original debt as well as the interest that has accumulated each month. At the conclusion of the mortgage term, if you make your payments on time, you will own your house altogether. If you're having trouble making ends meet due to rising interest rates, you might want to think about converting to an interest-only mortgage. You would only pay the interest that has accumulated on an interest-only mortgage, the debt would not be lowered. Consequently, your mortgage payments will probably be less. But bear in mind that at the conclusion of the mortgage period, you would still owe the same amount because you would not be decreasing the debt. When taking up an interest-only mortgage, it's always a good idea to have a long-term strategy. Will you eventually convert to a repayment mortgage? Or will you have additional resources at your disposal to settle the mortgage? So, we've explored the potential great mortgage shock, its causes, and its impact. Remember, knowledge is power. While the future is uncertain, being informed empowers you to make informed decisions about your finances. Now, the question is, what can you do? Talk to your mortgage lender, explore refinancing options, build an emergency fund. We've also compiled some helpful resources in the video description to guide you further. But this conversation doesn't end here. Share your thoughts and questions in the comments below. Are you worried about the potential mortgage shock? What steps are you taking to prepare? Let's build a community of informed individuals.